Greetings, everyone. Welcome once again to today's HQ Financial Planning Conversation, Lim Exclusive. Today is the eighth session. The bank is an important institution, the bedrock of today's economy as we know it. It wants you, and we need them. The bank does itself a great favor to be very careful not to lend to anyone. When it does, the loan agreement is more than 20 pages. It confounds the educated, the intelligent, and the knowledgeable, including many in the legal and finance fraternity. As consumers and financial planners, we owe ourselves that great favor as well, as we work with the bank to be aware of the risks associated in the context of financial planning. For this reason, we have decided to dedicate an entire session today to talk about the bank, to discuss the various concerns and the risks that many are not aware of. Many of these are subtle by nature as well. And I'm, again, I consider myself very honored, privileged, and very thankful to have this opportunity to work with Alan in this manner. And so once again, I want to welcome Alan to this conversation. And we have Alan, I'm handing the ball to Alan. And Alan, welcome. Over to you now.
Yeah, hi, good day. Thank you, Samuel, for inviting me back once again. It is already the eighth session. I'm honored to be back again. Now, thank you also for dedicating this whole session on banks. Now, I just want to present the technical perspective about what we are saying over here. I am in no way to imply that bank is inferior being versus a financial advisor. I am not doing that. As what Samuel said very clearly, all right. In the current capitalistic kind of economy, bank is indeed a very important institution. In fact, for every country, the government, one of the duty to maintain the stability of currency and inflation, bank plays a very important role. We cannot underestimate that importance for the banks. But however, in recent time, there is certain interesting development that I observe in the financial planning industry from the client point of view and also from the advisor point of view. I just share with you very openly, number one. When I first entered the industry about 22 years ago, when we buy insurance policy, we need to pay cash. All right. And in recent time, the financial ecosystem has developed that the bank is willing to lend you money to purchase a huge amount of insurance policy. It can be a universal life policy or a retirement annuity type of policy. Now, mathematically, it is true. When you do leverage, that means to say that you are using other people's money, you borrow money. The yield that you can get from a financial product is higher. There's a mathematic aspects of leverage financial planning. In short, you borrow money to purchase in assets. In this case, we are not referring to property. We are referring to life insurance policy or even a wealth management product like a bond or sometimes even structured products.
So the other term used is premium financing, right?
The premium financing actually is another term for the technical term is leverage financial planning. You use leverage to maximize your returns. But the problem is financial advisor and maybe the stakeholders, the advisory stakeholders, they stop short their presentation at the mathematic side of such a strategy. We all know that if you get into a loan, the client is actually essentially enter into a loan agreement with the bank. And therefore, this agreement has got legal power and contractual obligation imposed onto the client. So for a loan contract, if for whatever reason you can't pay back, is what we call the event of default. Later we will go through a sample of this such a contract, event of default. Your whole financial statement on your balance sheet or your whole financial plan can collapse now because you need to pay the money. If you don't have sufficient liquidity or capital to pay back the money during certain situation, client can go into a bankruptcy situation. In simple terms, it means your financial planning solutions could potentially become a financial planning problem for the client if you're not careful. And to go further, one more step, if the client faces a financial problem as a result of your advice, of your financial planning advice, say 5 years ago or 3 years ago, or even 10 years ago, nothing from stopping the client to sue the financial advisor on the duty of care. Why didn't you highlight the worst case scenario to me? Not based on the product brochure, no. Based on the loan agreement. Based on the loan agreement. So I was discussing with Samuel. I felt that maybe this is an important session that we should devote maybe an hour on this one to guide the financial advisor through. Nowhere you can find such a training, perhaps, as of now in the market that certain institution train the financial advisor in this aspect. All right. So we treasure this particular opportunity that we have. All right. Okay. Now I will do a share screen now.
Yeah.
I will do a share screen.
Let me enable it for you. Okay. Yeah, please go ahead.
All right. Now let's start with a very simple schedule of asset, or what we call a balance sheet, a personal balance sheet for a typical client. For a typical client, the data that you see on the screen is real. All right. Just at the name, I change it. The family structure for the client is Adam and Eve. It's a fictitious name, Adam and Eve. They're husband and wife.
Right.
Now, husband and wife is commonly, it is common that husband and wife, they own asset jointly. So this is a scheduled asset for Adam. You have property, savings, investment, insurance cash value. All right. And you have liabilities. Now, as a personal financial advisor, we cannot just record down the item, which is property, and as well as the market value. As a financial advisor, we also got to get two more important information: the ownership structure and holding institution. Then we'll have a very full picture of your clients' schedule of assets holistically, so that you can run through certain scenario to find out what's a potential red flag for the client. You can see very interestingly, this is a very common structure of a husband and wife. Property, they hold joint tenancy. That means they co-own together. They got savings, 100,000, and investment, probably some sort of unit trust, purchased from the same bank. And nothing wrong with that. And there's nothing wrong with that. Because sometimes bank will package their products together with a fixed deposit. I just had one example just yesterday. One of my clients called me up, and then very apologetically, she highlighted to me. It was a very comical situation, but I appreciated her respect for me, because she was calling me. She said that she accidentally purchased an insurance policy from a bank. She didn't know that I carry that. She actually wanted to cancel the policy and purchase the same policy through me. But of course, we all know that ethically that is not right. So I encourage her to stay put. There's nothing wrong with that. Stay put with that particular policy with the bank. There's nothing wrong. That policy is a good policy. All right. So she stayed put. And then I also take the opportunity to ask her about what the bank say or what the bank present that made her wanted to purchase their retirement policy. She mentioned one thing which I find is absolutely correct. She said that the bank, as a result of purchasing the policy, the bank will give her a better interest rate in the fixed D. In her fixed D, which is 2%. All right. Over 2 months. The 2% only valid for 2 months. All right. Provided you purchase this insurance policy. So bank can do product packaging in that sense. And mathematically, you can't say it is not beneficial to the client. Mathematically.
Right.
All right. Okay. Because as a financial advisor, we can't really package a fixed deposit. All right. It's a fact. So that doesn't matter. So therefore, as a result, you're beginning to see that the client beginning to have more and more assets hold under the same bank. Hold under the same bank. You take a look at this balance sheet. There's a mortgage of 600,000. It's held joint and several with the wife, Eve. And it's the holding institution, you can see that it's also the same bank. No? Also the same bank. No? Now, well, mathematically, there's nothing wrong in doing this one. But from the risk perspective, I think client need certain education, guidance, and matured counseling from a third party, in this case, a financial advisor, about the risk aspect. The risk aspect is what? What if for whatever reason the mortgage will run into trouble? The mortgage run into trouble. Does the bank has the right to go into the savings, to go into the investments, to net off the outstanding loan without seeking consent from the client?
Actually,
Without seeking consent from the client.
Alan, just my question.
Yes.
I remember one of the first sessions we talked about this case of Lim Exclusive, which was related to the all money open mortgage. Am I right now?
Yes, correct.
So in this case, when you say that, what if this mortgage get into problem, right? It could also be triggered by a similar situation that we covered because of the all money open mortgage, right?
Yes,
Where
correct.
in this case, one of the spouse could have also taken a business loan with the same bank. Could be even in another country, but same bank, right?
Correct.
And because of the all mortgage open mortgage clause,
Yes, correct.
it triggered such that if the business go down, all right, and that loan with the bank get into trouble, it would trigger the issue with this personal mortgage that in this case Adam have with Eve. Am I right?
Correct. Correct.
And
correct.
so it
Maybe,
trigger an entire string of ripple effects.
yes, correct.
Okay.
So Samuel brought out that particular case. Maybe we just refresh our memory. What that case is all about. It's actually inside this part here. Inside this particular diagram, let me just okay. This is the particular case that Samuel is referring to, that we presented in one of our earlier session.
Yep.
All right. This is the situation in which a loan get into trouble, and the man, Mr. Tan here, accidentally also get the wife into trouble because of one of the clause within the loan agreement. All right, which is the all money open mortgage. All right. For the advisor, you can reflect back to our previous recording to understand more about the all money open mortgage. But in action for this case is that the money owned by Mr. Tan can't repay the money. Mr. Tan got into a bankruptcy situation. That is very common. We all understand that. But the situation that because the wife right, go into a loan agreement under the joint and several liability obligation together with the husband.
But that's their
And
personal property, right?
Yes.
Whereas the
correct.
husband's side that went into trouble is his business.
Correct.
Right.
Correct. It is his business.
Yeah.
So the wife in this case was get chased for the outstanding loan incurred by the husband by the same bank. By the same bank.
Business.
So
business,
he went to the court,
liability,
and then
the loan. Yeah.
the wife lost a court case. So therefore, she is also liable to pay the 131 million. All right. So this situation, let's go back to just now our case study here.
Yeah.
You see, if any of the loans that get into trouble in this situation, under the joint and several liability clause, just now in the previous case, that wife got into trouble. Not because her own loan situation goes sour, the husband loan situation goes sour, but because she is being jointly and severally liable together with the husband under the loan agreement. Then she herself also get hit. Number one, and number two, when she got hit, can you see that right now we go up to the assets that this particular client have? He has got savings and investment also with the same banks. All right. The issue here is that the bank right now has got the right to take out the savings, to take out the investments. The technical term is called net off. Net off the savings, net off the investments with the outstanding mortgage. Yeah, it's reflected. You can see in the balance sheet here. And in just now, that particular court case, we talk about the OCBC versus Lim Exclusive. That liability is even don't even reflect, does not even reflect
In this
in
balance sheet.
the Madam Lim's balance sheet. No. So that's the danger part of it. So in this right now in this situation here, let me just stop share here. Let's run through a typical loan agreement and what are some of the points that the financial advisor need to understand and then reflect and then advise client certain strategy on certain strategy. All right, I will do another share screen. So are you able to see the loan agreement?
Can you please zoom in so we can see better?
One
Yeah,
second.
yeah,
Okay,
that's
can.
perfect.
It is under DBS.
Yep, sure.
As I mentioned, I'm not implying that this particular bank is an inferior bank. I don't mean that. All right. We are just taking this as an example. All right. In fact, all terms and conditions of a banks are quite standard. We have studied the standard cross, and in a very professional way, we study what is implication. What's the implication? Okay. I just want to repeat again. There's nothing wrong with the bank. All right. We have to respect them. We have to just study the technical sides of the contract from the risk perspective. Now, this is a typical terms and condition granted by a bank to the client when you enter into a loan. Very similar in this case is a property loan. It's the same thing when you do premium financing. There will also be a loan agreement that is being prepared by the lending bank to the client. Okay. Now, the issue here is that let's be very familiarized from the professional point of view. What are the clauses that might negatively impact the client from the risk perspective? Okay. Now, in the loan agreement, it spells out all the terms and as well as the clause. So I just want to go through some of the clause that is of implication to the client. The very first thing that we need to help the client to understand what are the events of default. What are the events of default? Right. In this situation here is page 12 or 20. Page 12 or 20. All right. Maybe I just want to counter ask Su Chong. Page 12 or 20 of the agreement. No. Does everybody read that far?
Oh, hang on.
In the
This
normal.
is 20.1.1.
Pardon?
Page 12. Okay, page 12. Yeah.
Page 12 or 20. Does people read that far? No?
I don't know, but it's perhaps just a guess. Unlikely.
No, the thing is, no, this is not a. I mean, I can ask it in a very comical, jokingly manner, but the viewers here, as you're looking at this video here, you got to sit down and pause and think through. And this is a very serious thing, no. When you sign any agreement, by having your signature on the agreement, say on page 1 of a letter of offer or whatsoever, as a client, as a person who signed, you're deemed to have read and understood all the terms and conditions. No.
I
It's
think
from a legal perspective.
if you ask me, I tell you my own case, right? I mean, I
Yes.
purchased my property. Yeah. And when you go to the bank and purchase a property, what is predominantly in your mind is like how you want your kitchen to look like.
Yes.
Right? You are thinking about your aspiration. The last thing on your
That's
mind
correct.
is to read this, 20 pages. And
Yes.
even
Correct.
you read it, understanding it is yet another question, am I right? Yeah.
Yes, correct.
So far
Correct.
from the mind, yeah.
Yes, correct. But what Samuel says is correct. So therefore, as a financial advisor, let's get ourselves familiarized with some of the clauses inside the loan agreement. All right, loan agreement. Okay. Now, you take a look at this part here. Clause number 21, called the events or defaults. It is very important in a loan agreement that this clause is there because under what situation the bank can actually pull back the loan. All right, event of default meaning to say that without prejudice to any other term in the facility documents and our right, which is a bank right, to demand immediately repayment of any facilities. Now, you might say that, hey, Alan, what's so difficult about this? I can't pay, it will trigger off an event of default. That's very straightforward. Answer is correct. But I just want to counter ask you, do you really understood how many in total that possible event of default that can cause the bank to pull back the loan? It's not only you can't pay, right? That's a 221.1.1. Any of the installment or loan interest payable are not paid when due. This is what is commonly understood by people, by advisor. But my point is that is not the only event of default, no. They are all together, you can see 2.1.2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Altogether, total 18 points of possible event of default, no. So therefore, we have to see this in a very professional perspective. What are some of the possible risks that can enable a bank to pull back this particular loan? All right. Now, look at 21.1.7. What does it say? Any of the party in this loan agreement die, become insane, or become unable to handle your own affairs. Why is unable to handle your own affairs? Meaning to say that in Singapore situation, it could be you're in the long-term care situation, in which out of 3 out of 6 daily activity or daily living that you can't perform, you're unable to handle your own affairs. And if the bank come to know about it, and if the bank felt that your creditworthiness has been greatly affected by you being in a situation that unable to handle your own affairs, the bank has the right to pull back the loan. See the part? Another thing is that when you die, pass away, a typical understanding is that when one party pass away, the other party can continue the installment. That is not right, no. Right? So what happened when one party passes away in a loan agreement, the entire loan agreement will be terminated. A new loan agreement will be generated based on the creditworthiness of the surviving party.
That means I backtrack a little bit. I backtrack a little bit. Now, just now you talk about the long-term care situation, right?
Yes.
It is not even this guy really cannot pay. He may be still servicing the loan continuously, right? Because maybe got savings, right? But he actually get in. Maybe the savings can last for 3 years. That means can still pay the bank for the next 3 years. Okay.
Yes.
But
correct.
because he get into that long-term care situation, if the bank happen to find out,
yes,
this default situation get triggered already.
No,
Even he still can pay for 3 more years.
yes. No. Let's be very fair to the banks.
Yeah.
All right. Any events or defaults that happens, give banks the rights to call back.
Correct.
Now, whether or not the bank enforce the right is dependent on the bank.
Dependent on the bank. But they have the right to do that.
Yes, they have the right to do that. So therefore, that brings us the situation about as an advisor. When we say we advise the client, we are the client advisor, we took on the duty of care for the client. Do we plan based on the worst case situation or a best case scenario?
You can't depend on the goodwill of the bank.
Yes, precisely. When we say we want to do planning, meaning to say that we run through the scenario, we think of the worst case scenario. Worst case scenario. It's always the worst case scenario. So the worst case scenario is that the bank get pulled back. No, the bank has got every right to pull back. No, you can't say that the bank is not exercising good humor, humane faith, not of good character. When people are down, you still want to pull back the loan. You can't put all those emotional criteria in. No, we are all talking about a contract. We are all talking about the bank is lending you money, right? And what right does a bank have to recover the money? Now, all the commercial laws in a capitalist economy actually protects the creditor, protects the lender. You can't say this is wrong because if that thing don't happen, you will find that there will be many people who just borrow the money and don't return. Then the entire banking industry can go into trouble. In fact, there is a situation happening in India. Only until recently, India has got Bankruptcy Act, the law of bankruptcy, in which they are able to have that act and then enforce it onto a certain insolvent company or insolvent person to recover the outstanding loan. Previously, they don't have no.
Serious? I didn't know about this.
Yes. So the entire economy actually like don't fulfill its maximum potential lah. All right,
Right,
there's a
right.
situation about that. So therefore, in Singapore, we have to be very mindful about this particular clause. So therefore, in this situation, if the bank ever get pull back the loan, or there's let's see other event or default. Let's take a look at 21.1.5. If any of your present, your means all the parties that's inside this loan agreement, in this case could be the husband and the wife, all right? Present or future indebtedness, or in respect of money borrowed or raised, whether from us, all right, whether from us, or any other person become capable of being declared due or payable before it is stated due, or any such indebtedness is unpaid when due, or as the case may be within an appropriate grace period. You know what does that mean? Present and future indebtedness, no. Present and future indebtedness, no. Now, present debt, I think, is reflected in the husband and the wife balance sheet when we do personal financial planning under the liability column. But let me just ask you a question, Samuel. How would you know my future indebtedness? The loan I'm going to take in the future, no?
I see.
How would you know? But the clause actually talking about any of your present, that means the loan you borrowed now, and also if the future loan you cannot, and the future loan that you took out from the same bank, and for whatever reason you can't pay back, also give the bank the right to evoke this clause, even a default,
for this
and
particular
allow the
loan.
bank to go back. Yes,
Yeah.
yes. So therefore, you see the danger of things, not only your present loan, you know it, you can control it, you can manage it.
Correct.
But future, no. And not only your future loan, no, your spouse future loan also, no. How do you know that whether your spouse will innocently take up a car loan in the future, another housing loan to buy another property, or sometimes very simple things, sign up another credit card
Actually, okay,
future.
let's take for example the both
Yes.
husband and wife enter into this agreement, right?
Yes.
And then you say future. I mean, this, let's say this affluent couple, right? The
Yes.
future, the wife by herself, let's say, found a very good investment opportunity, right?
Yes.
And take not even a joint loan, right? Take her own loan, right? Can also implicate this past loan agreement,
Yes, of
the
course.
future loan, right?
Yes.
No?
Yes.
Without telling, let's say, the other party, maybe their relationship not so good.
Yes. Yes.
Yeah.
This thing always happen. Sometimes this thing can happen, trigger off. Sometimes children accidentally inconvenience the father's financial plan. Meaning to say that, for example, a very simple, very common in Singapore situation when parents send their children, say, to Australia to study. The parents are still in Singapore. The daughter need a credit card to survive or to run her life in, say, in Melbourne. All right.
I
They're studying
see.
at University of Melbourne. All right. So the father will sign a supplementary card for that daughter, so that you can use it. The Singapore side as a principal card holder, he will pay for all the bills.
I see.
All right. Now what happened is this daughter that she go into a shopping spree lah. Like right now, there's a lot of ways to shop online. The 11th of November, the 12th of December, 10th of October. Now, almost every month, there will be some form of discount campaign by this kind of online merchant, right? Whether Alibaba, Amazon, or what. So he went on to this shopping uh, 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 spree, incurs such a huge amount that for whatever reason, let's assume that the father back in Singapore can't pay. Can't pay, never mind. The father say, okay, let's cancel this particular credit card. Let's figure out how to pay installment of that particular debt. Let's assume it's say 100,000. Say 100,000. Okay. But because his creditworthiness dropped as a result of the particular debt, let's assume that he also took out a mortgage loan from the same bank of the same credit card. That loan will also be called back. No? So let's say the loan is $3 million.
That he took with the wife, let's say.
Yes. Do you see that now? Because the action of the daughter linked to the supplementary credit card and linked to the father, and the father can't, for whatever reason, run into trouble because maybe in the pandemic situation, business not doing well, cash flow got problem. And then the loan get the credit card debts link up with the housing loan because of the same bank.
And also because this particular loan that get into trouble as a result of this is linked with the wife's name, right? Let's say Eve in this case. And Eve, let's say, also have the same bank. She have a joint account, like, you always say the account that she don't want the husband to know. Maybe Eve and the mother, let's say.
Yes, correct.
Right? That is really for rainy day kind of thing, right?
Correct.
Just in case account. That account also implicated because of this, can also be implicated.
Yes, can. So right now we understand the event or default. Meaning to say that this is a situation that altogether eating touch point in which potentially can allow the bank to pull back the loan. Now, you can't say the bank is wrong. No. I just want to emphasize again, the bank lends you the money for you to achieve your financial goals, no? Right? To buy a house, to do a business. You can't say the bank is wrong. It is just that the bank need to protect themselves by running through certain legal process for them to recover the money. If they felt that your creditworthiness has decreased to a point that to them that you are a risk. Okay? Now, ladies and gentlemen, we got to be very mindful now today in the IT world. Some of these event or default is triggered off by computers. No? Meaning to say that you might not have a person to discuss, hey, can you give me some grace period, that kind of situation. No? You got to be watchful on that. Now, now we understood event or default. Let's go up that. What is next? Next, which is the right of lien that the bank have and the rights of set off. The right of set off. You can see in clause 19 what is the right of set off? Now, the right of set off is inside the loan agreement. No? In addition to any lien means the bank has got some can recover some of the assets to net off the loans that you took from them and you can't pay. The right of set off or other right which the bank may have, the bank shall be entitled at any time without notice to you. Who are you? The client. Okay, as well as the wife, the joint account holder, to combine or consolidate all or any of your account and liability or to us in Singapore or elsewhere. In Singapore or elsewhere. In which just now we talk about that particular OCBC versus Lin So Chu. The husband incurred the loan in Hong Kong, no, but same bank or same bank.
I see.
But in Hong Kong, no. But also implicated, no. Or set off or transfer any sums in credit of one or more such account towards satisfaction of any of your means the client liability to us. Who is us? The bank. On any other account or account in Singapore or elsewhere. If you hold a private banking account or a private banking asset, a portfolio of unit trust or ETF or whatsoever of the same bank, say in Hong Kong or Malaysia or whatsoever, all right, can get implicated, no? Or in any other respect, whether such liability be actual or contingent, primary, collateral, several, or joint. Can you see that? Let me repeat how. The loan, which is liabilities, be actual. Actual means you have incurred and you know about it. What is contingent? Contingent meaning to say this loan will only appear when certain things happen. No. Your guarantor go haywire. You sign a guarantor for a company. That company go haywire during the pandemic situation. Coming to you. All right. Contingent could also mean that your spouse sign up a working capital loan in Hong Kong or in Malaysia to run his business in Hong Kong or Malaysia, and that loan come into trouble, and it become from contingent become an actual, and because you are joint and several liable with your spouse, you yourself also get implicated. Okay? Primary or collateral, joint, several or joint, or such account be held by you. What is this account? Assets. Be held by you in your name, singly. What is jointly? That means your joint account, no. Your joint account, no. Or jointly with any other person, and notwithstanding that, the credit balance on such account and the liability on any other account may not be expressed in the same currency. We shall have the right to effect any necessary conversion at our own prevailing rate of exchange. Do you see this part here from the event of default? It gives rise to right or set off. Right or set off of the assets that you have with the same bank. Not only held by you, no. You will also include the account that you held jointly with
other
another
people.
party.
So when it says the first line there, right?
Yes.
To be entitled at any time, and without notice to you to combine.
Yes.
So it's when the moment is that means let's say the wife has a joint account with the mother, okay.
Yes, correct.
Maybe inside there really is the kind of money that is important for the mother's long-term care, okay.
Yes,
right,
correct.
That means the money really cannot go wrong one. But in this case, right, the wife had a joint account with the mother because you think that it's just my name and my mother's name, right?
Yes.
Not my husband, so should be safe, am I right now? But in this case, because she have a joint account with the husband also with the property mortgage, so trigger off the ripple effect hit that account. And without notice means could be one fine day the mother go to the bank and just want to print the book, bank book. And realize suddenly the 300,000 becomes zero, right?
Okay.
Could happen, right?
Technically, they can happen, but the thing is, let me explain to you. The bank will inform you But when the bank evoke the right of set off, there's a communication process. You won't get a shock one, all right? The shock will sure come but it's not. You go to the bank, the bank will send you the letter
It depends.
to say that henceforth we are going
people
to
don't read
freeze your
their
account.
mailbox every day. Maybe they 3 days later then open the mailbox. Am I right? But today they go to the bank.
No, to be fair, the bank will write letters to inform that we have evoked the right of set off.
Of course. They have to
account.
They have to close the loop.
Now, yes, correct. Now, of course, viewers of this video could also include the legal fraternity. Let me just counter-explain. Okay. Some argument will say that, hey, Alan, why do you talk like this? I can prove that that money actually belongs to my mother or does not belong to me. But we open joint account for convenience. This joint account is for convenience. All right. Answer is yes. But let me counter-ask you. Who will have the ultimate right to agree your point and let you take the money, let your mother take the money back? The judge, which is the court. Not the financial advisor, not the banker. No. You need to prove in court. All right. The money actually belongs to your mother. You are holding it in trust. All right. Because to facilitate her long-term care situation. All right. Now, if the judge is very convinced based on the circumstances, based on the facts, written or otherwise, right? Then the judge will decide, okay, this indeed is your money, you can take back. But you need to prove in the court.
It's possible.
That is a situation. There's a situation that therefore, as a financial advisor, we need to run through this particular risk scenario with the client. Now, in English, what does that mean? Let me just go back to the balance sheet just now, so that we can learn some application point on that. As a financial advisor, what do we do? Notice we are financial advisor. We are not lawyers. We are not social workers. So whatever we learn, we have to always refer back, bring it back to financial planning. All right, bring it back to estate planning. Come. Okay.
So to emphasize or to clarify, right? Just now you made one point, right? In typical fact finding, which is basic or not, right? It's subjective, right?
Yeah.
The financial planner basically would register like the assets and their value,
Yes, correct.
But it's not mandatory, even under the company's fact finding, that they have to register the ownership structure and the holding. Am I right?
It's not mandatory.
It's not mandatory.
It's not mandatory. Because the company, they do not want to go into complication.
Correct.
They do not want to go into complication.
Which they do not need to.
Okay, let me just highlight at this point from the technical point of view. Does not mean that the insurance company or the bank are lesser being. They are not. They are important institution in Singapore or perhaps in the world. Now, actually, the Financial Advisors Act, does it actually talk about financial planning? The Financial Advisors Act, that's the one that regulates the bank and the insurance company. Actually, talking about suitability of products. No? Is the product suitable for the client's situation? No? Just like all the compliance situation is that product suitable for the client situation? And they will stop right there. No? Just like a bank, a financial insurance company, there is no need for them to go into estate planning, financial planning. No need to, no.
But
Just a
it's a
brief
bit,
one will do.
don't
No?
you think it's a bit grey? Then my next question
Yeah.
would be then,
Yes.
what do you mean by suitable? It's a big word down there, isn't it?
Oh yes. Oh no. The suitability is all the processes. The right now a licensed financial practitioner in Singapore they will face before the product can be recommended or can be placed. That means they
Absolutely.
ask about
Yeah.
what is your net worth? Do you have got the income?
Yep.
All right. Is it sustainable? Is the product can you afford to pay the premium? Or can you afford to put in the investment on a regular basis for the particular duration?
Sure.
What is the financial goal in the future? You're saving towards education, you're
Yeah.
savings towards a retirement.
Yep.
That's
Correct.
the mathematical side.
But then,
But
is it?
on
But
this
what?
part, we are talking
Yeah.
about the risk, no?
But then my question again, when we talk about
Yes.
that, right? I think the big word is the word suitable. Correct me if I'm wrong, right? I need the insight here, okay? Because if let's say the client tell you that, hey, Alan, I'm doing this because my objective is really that I want this for retirement, okay?
Yes.
So you do your basic fact finding based on what is required by the company, right?
Yes.
And you determine that, okay, this particular product would then be suitable, right?
Yes.
But the word suitable there is arguable, isn't it or not, right? If you fail to collect more information and find out the other associated risks, or in this case, those contingent risks and all that, right? And end up the outcome is not what the client actually want as an objective, right? Can then the client argue that that you did not do a complete job, and as such, what you did for me is not suitable now with on hindsight that a new situation like that occurred, and then the entire plan did not fulfill itself.
What correct? What you say is correct. But right now in Singapore situation, there isn't much of a court case that we can rely on to study.
I see.
All right. So far, we are all talking about the ownership structure, the holding institution. That's one, no. Because there will be another situation where conflict of interest can arise, no. So if a financial advisor is not very strong in the professional grounding that what his position is, he can be in a very difficult position. Now, Samuel, let me just highlight this situation over here. Yeah. It had to do with professional ethics. Now, let's assuming I am a banker. I represent a bank. For my job is to promote loans and also promote wealth management products. And my fiduciary duty is to the bank, my employer. Okay. When I look at client Adam needs a mortgage of 600,000, and he has got the in terms of suitability, financial suitability. All right, he got the right income. All right. He got the right qualification to justify the kind of job, say for the next 20 years or for the next 10 years.
It's a good risk, in other words. Yeah.
So as a bank, we lend it to him because we made a profit out of it. All right, reasonable profit out of it. And as a banker and employee, I will also want to promote savings account to him. From savings account, I also like to promote investment product to him so that as a bank can earn fee from this client. Am I wrong? I am not wrong. No.
Nothing wrong. Yeah.
But if I put into the professional perspective of risk, my right advisor ought to be, sir, you are putting too much wealth management product with me of the same bank. For your own good, I should not promote further wealth management product to you. For your own good, you should walk across the street and place the wealth management product with another bank. Because if you continue to put some more with me, if ever the event of default happens, it really gives me the right to set off your wealth management product with me. Now, will the banker say that? That means you're rejecting business, no? The similar thing, this also sometimes put to financial advisor in a very difficult position, no? If you don't represent too many product provider, you only represent one or two, and you're a very good financial advisor, and a lot of product is being placed in that particular financial institution. From the risk perspective, do you place more emphasis on the client risk perspective or your own fiduciary duty with the company that you represent? And this is a very tough question to answer, no? You see where I'm coming from? We have to see this in a very mature way, no?
Because for that matter, like one example is
yes.
every company should death occur to the client, right? They're able to pay the first 150,000 without the death. I mean the death certificate of course, yes,
correct.
but without needing the letter of administration or probate. Am I right? No?
Yes, correct.
So, for example, if a good advice is that actually if the client have two policies from two different companies, then the total cash that could come out and help the family during that difficult period would then be 300,000 because it comes from two separate companies.
Correct.
Right.
But the thing is, Samuel, I also wanted to make a point because I am not here to say that the financial advisor who only represent one platform are inferior. I never say that, no. I'm not saying that, no. Because you might look at this in this way and thought that I say that. I don't mean that. I don't mean that. I just want to give a very professional and impartial objective from the risk perspective of over concentrating of asset and liability into one institution. And this discussion right now is banks. Bank got what? Liability product and wealth management product.
Right.
So from the loan contract, I had demonstrated to you based on evidence that if ever the liability get into trouble, the wealth management product can be impacted, used to net off the loan.
Yes. So what you shared with me the other day, right, about the wealth management product, right? You mentioned that, for example, if I purchase a unit trust through a bank, let's say with Templeton, for example, I think it is best that you explain better than me.
Okay, let me explain that. All right, because right now, the banking side, they're very competitive. When you look at the client, from the profit point of view, besides lending you money, they also go into the fee business. Meaning fee means what? You sell certain product or wealth management product, they get certain commission or what from the product provider. All right. So sometimes when you analyze a bank balance sheet, as a shareholder, they always talk about our fee income. The bank fee income is how much. That usually come from wealth management products. Now, when you purchase a unit trust or a collective investment scheme from a bank, the bank is your platform, no? So the bank will act as a like a nominee, to hold your unit trust, no? All right. Now, from the fund manager side, say you purchase a Templeton fund, the Templeton side will not know your existence one. No? They will only know the bank's existence. All right. The bank will hold this money, all right, on behalf of you. You're the client. The bank hold this money. So every month, the bank will send you a statement, this situation. Now, therefore, if you get into a loan agreement issue, does the man has got the right to net off that particular unit trust in that platform that is they hold for you? The answer is yes. There's a situation. Now, the other gray area is what about if you purchase insurance policy? Now, if you purchase insurance policy, the owner, when you sign out the application form, the owner of the policy is actually the client. Correct? So long you don't get involved into a premium financing situation. If you purchase an insurance product from a bank, you are it can be it is quite safe that the insurance policy will not be affected by this right offset offer because you are still the owner of the policy.
Okay.
All right, that's out. So therefore, what is the lessons to be learned over here? That you look at this balance sheet. There's an investment of 233,000 with the same bank. There's a savings of 100,000 with the same bank, and there's a liability with the same bank. So the financial advisor, when you detect this, from the risk perspective, I think sometimes it's better to counsel the client and say that maybe too much of your wealth management product is with the same bank in which you have one of the main liability.
Right.
Why don't out of that 100,000 savings you took out and then you put in another bank, say savings. So if for instance the saving is for certain long-term financial goal like child education, retirement, maybe you want to put into a endowment policy with an insurance company so that you diversify out from the holding institution. You see the part? Number two. Number three, you take a look at the investment, the 233,000, also with the same bank. Why don't you consider taking out with a financial advisor, also having the unit trust platform to diversify away from the holding institution?
Right. Right.
From the perspective of risk, no. From the not from the perspective of mathematics, no. From the perspective of risk, no. Because from the perspective of mathematics means what? Nothing from stopping the bank for packaging the product to give you better interest rate of fixed deposit. But the thing is, the client also has to be mature enough to take a look. The extra 0.1%, the extra 0.2% of the fixed deposit, which is what you call the benefit. Compare that with the risk. What is the risk? Your entire account can be used to net off the liability.
Right. Right.
We are talking about the main liability. In this case, you can see his main liability is 600,000. His saving is 100,000. Liability is more than the savings. Unless you're telling me that the asset is 10 million, the liability is 600,000, then okay. Because if they net off your 10 million, you still got a lot left.
Correct.
But in Singapore situation, during this pandemic situation, there are many research that being done. How much savings, emergency fund, a typical client have? Does it last 6 months or 1-2 years? We all know that there isn't much. So most of the situation in Singapore situation is that the mortgage, the liability is more than the assets one, the savings one. All right. So therefore, the client have to see the point that the extra 1%, 0.1% that is given by the fixed deposit because you buy the product from them. All right. Compare with the risk. And back to the example that
Doesn't make
about
sense.
the fixed deposit 2%, better fixed deposit 2% is for 2 months only, no.
Yeah, exactly.
So 2% you divide by 12, it comes 2 months. It's not much, no. You got to see in that part, no.
Yeah.
So therefore, a financial advisor should be in the position to highlight based on the loan agreement, because the evidence is based on the loan agreement, not product brochure, not some sales idea. It's not. Very coolly present the loan agreement, the event of default, and study the event of default, which are the clause that is relevant to the client situation. Especially when you detect from the balance sheet that there are certain joint account, whether joint account in asset or joint several liability on liabilities. Number one.
And actually, for the advisors, right? I mean, many
Yes.
of our own users on the HQ platform, to extend this part, it's not that difficult. We basically have like what you have here, a spreadsheet like that, where you add 2 more columns,
Yes.
the ownership structure and
Yes.
the holding
Yes.
institution. You are already quite easily able to analyze this entire thing, isn't it?
Yes. Yes. Correct. What Simon said is absolutely correct. We just have to run through the scenario What if Adam died? The loan become event of default can take back, ma? What if Adam get into a critical illness situation? That could also potentially affected the
Set off.
600,000, ma?
Yeah, yeah.
All right. What if Adam guarantorship, he signed a guarantor for his own family business, get into trouble, will affect the 600,000. Then from there you analyze what are some of the assets that is of the same holding institution.
So for example, just now you mentioned critical
yes.
illness.
Yes.
Based on one statistics that I'm aware of, I'm not sure if this is still correct, right? 2 or 3 people today could be diagnosed with cancer. And of course, might not be the kind of cancer that will surely 100% take your life. It could be early stage, am I right? So, meaning to say, if a person have, let's say, a mortgage like this, 600,000, okay?
Yes.
And he or she get diagnosed of critical illness, right?
Yes.
That itself could also be a default, a scenario that the bank could choose to set this off as well.
Yeah, correct. But to be fair,
Yeah.
all right, the bank don't just put up that clause just because you got critical right away. It doesn't happen that way. To be fair, if the critical illness situation that give bank any reason to think that your credit worthiness drop tremendously, meaning to say that you're so serious, you are out of job.
Yeah. That's
Right.
Exactly that's what I was actually
Yes.
about to mention as well, because
yes, and you can't demonstrate to the bank that you have sufficient capital liquidity to potentially hold on to the outstanding loan. The bank can pull back off.
I see.
So therefore, the critical illness policy is important in this situation to provide the financial bullet to show the banks that you are financially capable of really handling that liability.
But this part, Alan, when we
Yes.
normally talk about buying a critical illness product, predominantly we're thinking about treatment.
No.
No, yeah, but at least from what I understand as a consumer, right? My advisor would tell me that yes, you need that for treatment. How many actually tell me that, hey, if you have a mortgage situation, certain portion of that money, could be set aside to convince the bank that, this is what I have set aside for, right? And as such,
Yes.
giving them the confidence that this need not be set off, right or not?
Correct.
Yeah.
No, a critical illness is not really only for treatment. No. Now, there's a methodology of calculating how much a person's critical illness need to be. Actually, it's the same for death, same for disability.
Right.
Number one, you need to create sufficient capital and liquidity to pay off loans. I'm talking about critical illness situation. You need this part,
Right.
Then number two, you need sufficient capital for income replacement, which is 10 years of income, 5 years of income, 3 years of income, or 20 years of income, that kind of thing, based on the client situation.
Yep.
All right. Then the third part, say adjustment funds. Adjustment fund is something like what Samuel talked about, the treatment. Most of the treatment ought to be mitigated by hospitalized and surgical medical insurance.
Right.
Most of it.
Right.
Right. So you have this part here. Now, I'm not saying this for fun. No. I have shown you based on evidence of a loan agreement what the bank's rights can have on a critical illness situation that you can't handle your own affairs. The bank has got the right. You can't assume that the clause don't exist. So therefore, when we from that understanding of the event of default, and then the bank will go to see what assets that you have with them. If you can't start pay off the loan, all right, what assets that you have, then they net off.
I see.
All right. That's a problem, you see. Of course, worst case situation is that your property also you will lose it because the bank will auction off the property, and then to net off the outstanding loan.
And then there's another scenario whereby husband and wife, let's say Adam and Eve, okay? So event of that happened to, let's say, Adam, right? And even if to the bank, Am I right to say this? I just want to clarify that, unless there's a mortgage term, reducing term that covers this property. So if like one of them, die straight away, this policy immediately will come in and then pay off the entire loan. But if this is not the case, the bank will not just simply let everything stay as per normal. The moment the one of them husband died, it's as good as the entire loan agreement is already cancelled already. Am I right now?
Yes, cancel.
It's
Correct.
cancelled, right?
Yes,
And
correct.
even the wife can continue to pay the same repayment, right? It's not like the wife will naturally just continue to pay the repayment, because this is the part that I also got to find out recently, when people say buy a home, there's a lot of emotional attachment, They really
Yes, correct.
take it that this is really my home. Am I right?
Yes,
I own
correct.
the place now. How many holes I want to drill on the wall and all that is my decision. Am I right?
Yes, correct.
This is a lot of
Correct.
emotional attachment. Am I right? But when
Yes.
when one of the key person passed away, the husband, right?
Yes.
The bank basically, hey, loan agreement terminated, no, right?
Yes, correct.
And then they'll relook at the wife, reassess the wife's
Creditworthiness.
creditworthiness or not, whether or not to
Yes,
actually set up another new agreement, so that
Yes.
you can
Correct.
continue to finance this house, whatever is a balance,
Correct.
and continue to own the house that you have assumed is yours,
Yes.
right?
Correct. Correct. Yes.
And in which case, not every Eve is a rich one, okay? Because they
yes, correct.
jointly get the loan, they combine their creditworthiness. The bank grant the loan based on two persons'
Yeah.
creditworthiness, right?
Correct. Correct. So there's many scenario on there lah. You see, what Samuel says is correct lah. This there's a poem. In a world a home. In a home your world. A home is a world, no. Is a world for your own family, no. Sometimes the financial aspects of it that a client don't think that deep or that far that deep, that far. And our human mind is not wired to think about risk. Our human mind is never wired to think about risk. So you really need a financial advisor who is competent enough, competent experience, and then to highlight the risk in a very professional manner to the client. All right, some of the scenario that could happen, and what are some of the legal clause of a loan agreement that can cause your whole world to collapse.
Yeah.
It's no fun, no, to cause a whole world to collapse.
So the
I just
poem
give you
is
one
that in the world, your
in
home,
the world a home.
a home, in the
In the
home,
home,
your world.
your world.
Wow.
One of the
Simple, but
poet
very
from German, Germany,
very
from
deep,
German. I think his name is Cote, something like that.
mm.
No, it is no joke, no. I always mention about the duty as a husband, duty as a son, duty as a father.
Absolutely.
I want to highlight this again.
Yeah.
If ever that we accidentally bankrupt our spouse or the house collapse because of financial situation, inability to pay, I mean the house get auctioned or pulled back. Someday when the man passed away, someday the wife also passed away. Let's assuming that they can meet somewhere in the spiritual realm. Let's assume spiritual realm. The wife will look at the husband. The wife just have to say one word. Why did you do that to me? How would the man answer? See the part?
I also didn't know.
No, correct. You didn't know.
Yeah.
So therefore, this is the purpose of maybe this particular conversation that I have with you.
Yeah.
All right.
Yeah.
We go deeper about certain things that not so obvious. But it is the not so obvious one sometimes can cause a lot of havoc.
And you
life,
always mention that contingent risk is
yes,
normally huge
correct.
and sudden, right? When
Correct.
it appears.
No,
yeah.
I am in no way to downplay the intelligence or competency of bank advisor. I am not doing that. No, I'm just coming across as a human being,
these are facts,
as a professional,
yeah,
as a practitioner.
Yeah.
That You take a look at the loan agreement. There are 20 pages. No, I highlighted on page 12. Does people actually read under page 12?
I think
It's a very
you
practical aspect that I just want to
but
bring
this
on the
is
table because the viewer of this video could be bankers.
no. I think whether you are, I'm very sure the banker will look at this one day. Including the legal profession, right, and the finance profession. And these are facts of life, lah, right? This institution is set up the way they are. They owe themselves the right to protect their own interests, right?
Yes.
Like you said, if they don't do that, then the entire institution will collapse. The economy will collapse. Okay, but actually, there's an interesting fact as well. I always hear you talk about the primordial duty of a human, right? The duty as a son, as a husband, as a father, right? And and you also mentioned, you also know that it's very a passionate topic for me, something very close to my heart, that I find
Yeah.
that the biggest problem in our industry, right,
Yes.
is not prospecting. It is actually a professional self-esteem issue, lah, right?
Yes, correct.
This self-esteem can only be solved, right,
Uh,
by the increase of knowledge, okay,
yes.
and the adoption of a working system that is able to sustain the business for the long run, and the client wanted that as well, right?
Yeah,
Eh,
correct.
but this is a fact. I just want to point out. And again, if the financial planner understand this, I believe you will raise their self-esteem, right? And this is not to put the bank down, but the bank is
Yes,
like
correct.
that, right? When they want to sell you a loan, a product, they're always very
Yes.
nice. At the first sign of trouble, the bank is the first to boot, they protect themselves, right? You
Yeah,
just lost
correct.
a friend. You just lost a friend, okay, from the
Yeah,
bank.
correct.
But
Correct.
financial planners, take heart,
Yeah.
you are the only one, that at the sign of trouble, you're the best friend of your client, I mean, that
Yeah.
I have one friend that's very creative, he actually went to tell a prospect,
Uh-huh.
say, imagine, I mean, touch wood, nothing happens to your husband, but supposing, right, something do happen, okay,
Yes.
I'm the only one that will come where everybody come to you and put past your, what we call the Peking Wee, $50, $100, $200. I'm the
Yeah.
only person that will come with a $500,000 check. I'm the only person that can do that.
Yeah.
So
Yeah.
so with that, right, the beautiful importance of the financial advisor, and you always say that the importance, how important it is for a consumer, right, to have a very good trusted advisor, knowledgeable one, that's not related to them, and as such,
Ah,
is able to provide very
yes.
objective advice, right,
Yeah.
through different
Correct.
stages, right.
Yeah.
Okay, so
Correct.
guys, I think we actually
Ah.
actually put a timer. We are like 1 hour 15 minutes. It's
Okay.
a
Okay.
it's a really good time.
Mm.
We managed to cover this. So guys, look out for the description. We always put timestamp, what we call key moments. Right, you can actually jump to specific section. Right, in the
Yep.
video recording, we have
Yes.
recorded 7. This is the number 8, and please feel free also to share this video if you find it useful, right? With your colleagues, with other friends in other profession that's associated, also with your clients as well. So, Alan, once again, very, very very thankful for this session with you. Yeah,
Yeah. Yeah.
and yeah, guys. So, I wish that you continue to stay safe, and you will continue to be that trusted advisor for your clients, and you'll definitely do very well. So till we see you again, okay? So take care. Have a
Thank you. Thank you.
very nice day. Okay.
Thank you.
Cheers.
Thanks. Okay. Bye bye.
Ciao.